Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. I'm Scott Hansen.
I'm Pat McClain.
Glad you are joining us as we talk about financial matters. Both myself and my co-host, we are financial advisors and spend our weekdays helping people plan their financial futures. We come into the studios on a weekly basis to be your financial advisors on the air, and love to. Our hope is that you make better choices with your finances, have some greater financial peace in your life as a result of listening to this program. So hopefully that we're accomplishing that. And we love taking calls. If you'd like to join the program, our contact number is 833-99-WORTH. Again, 833-99-WORTH. That'll get you on with Allworth's Money Matters. And we're going to start this week's program right off the bat in Colorado with Brad. Brad, you're with Allworth's Money Matters.
Hi. Thanks for taking my call.
Yeah.
Hey, so my wife and I are looking into downsizing kind of as we move into retirement. And
how old
one
are you,
of the
Brad?
things coming up is, I'm 59 and my wife's 62.
Okay.
And as we've been looking into the downsizing, one of the interesting things that came up that I wanted to ask about was not something I'd heard about a lot, but it's purchasing a home with a reverse mortgage and exploring that option as a means for controlling cash flow. Now, I've come to find out that since I'm 59, I don't qualify.
That's correct.
But I'm still interested in the concept, and maybe down the road, or just your guys' thoughts on reverse mortgages.
Also, if it was in your wife's name, but not that necessarily I could recommend that, but it's something you could do.
Yeah, I wouldn't want to do that.
Yeah,
either.
you don't want to do that. So let's talk about the rest of your financial situation before.
First of all, let's explain how these work, because I would imagine most of us that are being participants in the program today don't quite understand what Brad's talking about here.
Good idea, Scott.
Think of a reverse mortgage as a traditional type of mortgage, with the difference is there are no interest payments required. Interest still accrues, but there are no payments required. So let's say that you have a reverse mortgage on your house of $100,000, and the interest rate is 4% on it. I'm just throwing a number out. At the end of the first year, the mortgage balance would be $104,000. At the end of the second year, it'd be $108,000 and some change. At the end of the third year, it would continue to compound about itself and grow larger and larger and larger. But one would expect that over a long period of time, home prices will continue to increase in value. So whatever equity you have in the house, odds are you would still have equity down the road. And if something happens and you don't have equity, maybe you move out when home prices are down or whatnot. They're 90+% of them are insured by the federal government to make the lender whole, so you're not responsible for it. And what some people can do is...
And Scott, may I add that?
Yep.
So what determines the amount that you can borrow is the age and the value of the home. So the younger you are, you have to be 62 to qualify. The younger you are, the less money they will lend you, because they're doing a calculation as to break even. The bank doesn't ever want to lose money on this. The investors don't want to lose money on this. So if you're 62, let's say you can borrow 50% loan to value. And if you're 82, you could probably borrow 85% loan to value. The older you are, the more equity that you can borrow against in the house.
And you could use them. Let's say that you're going to buy a house at $400,000 and the loan to value, let's say, is 50%. You put down half, the reverse mortgage pays the other half. Now you are guaranteed to live into this house until your dying day and never have to make a mortgage payment. All you have to do is make sure you keep up on your property taxes and maintenance on the house.
So what's the downside to it? Right? The downside is you better be pretty darn sure that it's the last house you're going to live in.
Yeah. It's more expensive than a traditional mortgage.
And it's more expensive than a traditional mortgage. So let's talk about the rest of your financial situation. So how much money do you have in equity in your home today?
Around $420,000.
And what other assets do you have?
Other than like 401ks and
Yep.
money, that kind of stuff, IRAs. about $620,000 in IRA and a little bit in the 401k.
And do you or your spouse, do you expect to receive a pension?
No.
So the value of your home is how much today? You said you have $420 in equity. What's the value of the home?
Yeah, the value is around $620.
And what would if downsizing, what would that house cost you?
A new house, we're finding anywhere from $550 to $650 is a comfortable home.
So you're not downsizing value. You're just changing the
square footage, pretty much. Yeah.
So a nicer home, but smaller, nicer home.
Yes.
Or more desirable neighborhood, or something along those lines.
More, kind of like that. The neighborhood we're in right now is pretty nice. It's just the house.
And at what age do you plan on retiring?
Right at 67 for myself. My wife is pretty much retired right now.
And does she have a pension?
No.
All right, so it's basically, is she drawing from her retirement account or just your salary?
Yeah, it's just my salary. We're not drawing right now. I don't want to draw.
And what's the family income now?
I'm a freelancer, so it varies every year, but it will.
On average,
if we take COVID out of the equation, it's going to be somewhere between 75 to 100.
I think it's wise that you're looking at this option, but number one, you don't need it now.
I wouldn't do it.
Right.
It really it makes sense. The older you are, the more attractive this technique can be to help increase a family's cash flow.
But I wouldn't do it out of the box.
Particularly while you're still working.
If I wanted to make the move to downsize right now, I would downsize right now, keep everything else remaining equal, take a new 30-year mortgage on that, and then decide you've got 8 years until you retire. Lots can happen between now and then. I'm glad that it's on your consideration list, but I wouldn't recommend it for you.
Not yet.
Okay.
And by the way, at full disclosure, at one point in time, Scott and I started and then sold the largest reverse mortgage company.
We didn't start the largest.
We didn't start it.
It became that way.
We started it from scratch. And by the way, it wasn't targeted towards our wealth management clients. It was targeted to a whole nother section of the economy, which is the largest asset that a lot of people have is in their homes.
The average buyer was a 78-year-old widow who didn't want to leave her neighborhood. She had already lost her husband, lost her her work environment, right? So most people do not want to leave their house as they age, and it enabled them to pay off their existing mortgage and have additional cash flow.
And so it's not either good or bad. It's either the appropriate tool or the inappropriate tool. And for you right now, it's not the appropriate tool. So I wouldn't wait till I retired. If I was going to downsize, I'd do it now. I'd get a new 30-year mortgage on it. I'd put as much cash down as I possibly could, and I'd work as long as I could.
Yep.
Okay. You said 30-year mortgage. It's kind of surprising
30-year.
There.
Well, here's why. You're never going to pay this mortgage off in your lifetime.
Right.
Right?
Unless you say I'm going to work hard to get it paid off by the time I retire.
And what's the point in that? So if you can't get the house paid off by the time you retire, if it's not in the short-term goals that you can effectively pay this mortgage off by the time you retire, then take out the longest mortgage if they had a 50-year mortgage. It's that much closer to a reverse mortgage.
That's right. That's
true.
It's the same thing.
Well, great. I appreciate it.
All right. Glad to talk to you, Brad. Wish you well.
Which is, he's right, because we preach paying your house off before you retire, but not at the sake of...
well, his wife is retired.
But he's not, and he's still got $70,000 to $100,000 a year in income.
Yeah, and he needs to continue to save, so he's got enough money when he quits working to make the family
And at that point in time,
budget.
You could decide to rather convert the forward mortgage into a reverse mortgage.
If he said my income's probably going to be quite a bit higher the next several years, but it sounds like it's because it's variable. I would rather see him at a lower monthly payment.
Yes.
All right, let's continue on here with Allworth Money Matters. Our contact number is 833-99-WORTH. We're talking with Dave. Dave, you're with Allworth Money Matters.
Hey, good afternoon, guys. Nice to chat with you. Hey, that was kind of an interesting call. I have a similar call for a similar question. I just sold some property, and I'm trying to decide: do I pay off my house, which I owe about 150 on, or do I just take the total amount and invest it in the market, in the stocks, and that sort of thing?
How much how much did you net after costs and taxes on the sale of this property?
About 500,000.
And you owe 150,000 on your home.
About 155, I think it is. Yeah.
And what's your house worth?
Probably 750, something
And
like
how
that.
old are you?
78.
And what's the interest rate on the loan?
2.75, I believe. I got a pretty good rate.
And do you owe anyone else in the world money?
Not really. Our cars are paid off. We don't have any debts. We're helping our kids through college and that sort of thing. So, I still work. I have a business on the side that was not on the side. It's my primary business. I started 20 years ago, and it's doing well.
So you started this at age 58?
I thought
That's
exactly
awesome.
the same thing. Good for you.
Yeah.
Good for you.
The company I worked for 25 years, which I thought I'd retire in, was bought out by a bigger company, and we lived in California. I was general manager of one of their operations, and a year after the acquisition, they came to me and wanted to move me back to Chicago, where I'd been for 10 years with them. And my wife and kids said, "You can go, Dad, but we're staying here." So I decided, well, I'll start my own business and stay in California with them.
Oh, good for you.
So here's one way to look at this.
Well, what would you do with the proceeds if you were to invest them? You'd put them all in the market?
Yeah, probably. Well, I'm partly into, I have an annuity that I'm not high on annuities. I know you guys aren't either. I listen to you every week. But I'm big on stocks. I'm really ticked off at my current financial analyst because when I converted to them about 6 years ago, they convinced me that at my age I should have low risk. So they put me in an annuity and took me out of the stock market, which some of the stocks that I had, which was Tesla and Lam Research and Applied Materials. I'm in tech because I sell in the tech business. Those things have all just really quadrupled and or more.
So let me ask you this: if you came to a visit with a financial advisor, and your home was paid for, and you had $350,000 in cash to invest, and they said, "Hey, Dave, here's what we'd like you to do. We want you to go get a mortgage on your house of $150,000 and add it to your money, so you have a full $500 to invest with us, because the $350 is not really enough. Go take a mortgage on your house." What would you say to that advisor?
I'd probably say no, because I think at my age, I have to look at how long am I going to be around. I'm hoping to be around a long time. Plus, my wife is right there with me on age, and I want to make sure she has a place to stay.
Well, then you just answered your question.
And how much money do you have elsewhere in IRAs or annuities or everything else?
Yeah, about another 500,000.
Yeah, I would definitely have this paid off.
I'd pay it off. I'd pay it off. Pay it off.
You pay it off?
In a minute. Right now.
My house is paid off.
My house is paid off.
Yeah. Oh, good for you guys.
Well, no, I mean, yeah, there's just a peace of mind of it not having to deal with the mortgage payment.
Yeah. Well, I have another question for you. The business that I have is that I started 20 years ago is doing well. I brought my son-in-law in 5 years ago, and so I'm looking at a buyout package for him. We have two other employees, or actually 2.5 employees. We have a half-time person that's in the office, and I had it appraised. The appraisals ran from $1.5 million to $2 million, and which I think is high. What would be the best way to make a transition for me to get out and for him to come in as a full owner and still have, let's say we come up with a sell price of it of $1.2 million or something like that.
Yeah.
How would the best way to handle something like that?
How many other kids do you have? And this is your son-in-law.
We have 3 daughters and 6 grandkids. So
okay.
part of that will go to college and stuff like that.
So, and above and beyond your salary, does it have excess cash flow and your son-in-law's salary?
Yeah.
How much?
I got an independent appraisal of 1.5 to $2 million. Probably at 5 times earnings or something.
Yeah. So you can. There's lots of ways you can structure this. You can put a note on it and have him buy that way. He can, if he has any other assets, I'd like to see him bring some assets to the table. So he's got some more skin in the game other than your skin, his skin.
It is his
When you
wife's
say put a
husband.
note on.
I understand that, but still.
I mean, his daughter's. I mean, his daughter's husband. I mean, what a great position to be in, frankly, right? That's really cool that your son-in-law is working so well that you want to just get the business transferred.
Does he have any access to capital that isn't yours?
Yeah, I'm sure he does. He's done well. He came out of the financial world, and I don't think their house is paid off, but it's pretty close. So he's got 2 kids in place right now.
Maybe if he comes up with 20% down
or more,
or more, and then structure a note over the next 5+ years for the remainder amount.
And this might be the right calendar year to do it. I don't know what's going to happen in taxes in the future, but
that's a good point.
Because of what, taxes?
Taxes.
I don't know.
Yeah.
I don't think they're going to go up with all this trillions and trillions of dollars.
And do you still live in California?
I still do.
Yeah.
I'd like to move to Nevada because there's a lot better tax.
Well, we'd like Nevada. I'd actually like to stay in California. I just want Nevada to move to California with their tax rate.
Just their tax rate. Yeah, me too. I love my neighborhood.
You can keep the geography and the weather. We just want the tax rate.
That will set up a post office box over there for my company.
I don't think it works quite like that.
Yeah.
So you and I was being sarcastic when I said trillions of dollars, and we're not expecting taxes to go up. We clearly expect that there's going to be change in tax law. I would go to a good quality attorney and involve some financial guys in order to structure a deal. But you do want your son-in-law to have dollars in the deal, and you really need to let your other children know about this, because I have seen it more than one time where it creates animosity among the children that somehow their inheritance went to one of the children. Yeah. Unless you really like this daughter more than the others. You really want to make sure that there's visibility for the whole family, and that because it will create animosity in the family if all of a sudden they believe that the one son-in-law got more of the inheritance because he was closer to dad and mom.
Well, there could be some animosity just because the one son-in-law is hanging out with dad all the time. And
but you've got to recognize that that's an unintended consequence of the sale of the business. But it doesn't mean you shouldn't go through with it. You just need you need to try to mitigate it.
That's a very good point, and thank you for bringing it up. We're very cognizant of that. We're pretty transparent with all 3 daughters. We all get along, So that you're absolutely right. We got to establish it and function some sort of a functionality that everybody agrees to, and we'll be upfront as we go through it.
That's right.
And
and by the way, it's not that you getting along while they're alive; it's them getting along when you're no longer here.
You're not. Yeah, that's right.
That's what you worry about.
Well, hopefully that won't happen. The other son-in-law has no interest in the business, and there is no third son-in-law, so we don't have to worry about that. So,
there are daughters who could be in the interest.
Women do work in tech.
Yeah.
That sounded pretty funny.
Not great.
I have no other sons. Who am I going to leave my inheritance to? I have no sons.
Okay. The Middle Ages called.
Funny.
The Middle Ages called. They want their business model back.
I told the third daughter last year at Christmas. She lives in the L.A. area. And she came home for Christmas, which she always does. And I said, I guess you're destined to be a no-maid. Boy, was that the wrong thing to say.
Oh my! Oh, okay. We're gonna leave you at that.
Thanks for the encouragement, Dad.
All right, Dave. Thanks for the call. We're gonna leave it there.
That's funny.
There are all kinds of people that listen to our show, so we're gonna leave it at that.
I know.
And by the way, at the beginning of the show. The comments of our callers are not necessarily our recommendations, or do we agree with what they always say? But we did like Dave, though.
Oh, certainly. Yes.
He's kind of funny about it.
And by the way, I like lots of people that when I don't always agree with everyone's opinions. Yeah. Doesn't mean I can't really like them. People in my life I love.
What do you mean?
It's just such a divisive era right now.
Oh, Scott, if you disagree with me in any way, shape, or form, I hate you. That's just how.
You must be the devil.
What do you mean you have a different? You have a point. Once my wife and I couldn't decide on where to go to dinner. I didn't talk to her for 3 days. I'm just like that. I'm bringing this thing all the way to the end. You can't agree with me. It is something, isn't it?
The era that we're in right now. It's every week you read about somebody they state something.
Yeah.
I read an opinion piece on, who wrote this? Rush Limbaugh passed away recently, obviously. Everyone's probably heard that. And it was a very, I think, a fair article about him and his radio program, and they brought out something. He had said something pretty nasty 10 years ago or so, and then they calculated how many hours he had been on the radio. And then, so when you think it's 24,000 hours or whatever it was.
I got to tell you, though, my brush with greatness, when I was in college, I was a waiter at a restaurant. Rush Limbaugh got his start in Sacramento on the same station that we're on.
No, we got our start on.
Yes,
KFPK.
KFPK. But when I was in college, he would come in for lunch quite often. I would wait on him, and he was a very pleasant guy and a pretty decent tipper. I do remember that. So that's all. I never really listened to him a lot. I listened to him a little, but he was a pleasant guy, at least in person.
He was pleasant or wasn't pleasant?
When I was waiting on him, he was as pleasant as a patron could be, I guess.
Yeah, well,
that was my brush with greatness.
I don't know what my point was on that. I think I read this last week. But it was someone was a CEO of this or head of this stepping down because made some comments, and it's just an error. Like right now, like you make one bad comment, and
you're done.
I mean, if Dave was a CEO of a major company and made a comment like that.
Oh, lots of trouble.
Right? I didn't mean anything by it. It's part of its...
Pleasant enough, man.
Anyway.
We're going to get in trouble even talking about this.
We do try to be very apolitical on this program.
Yes.
We want people to... We do... I mean, I understand that if people differ with us that... Although years ago, we had a client, he was an artist. Now, I tend to be pretty fiscally conservative, as one would probably expect. And he said to me, he's want to talk a little about politics. Scott, are you a Republican? And I said, what would you, first of all, I'm in the financial business. What would you expect? Well, I expect to be conservative. I said, and you're in the art, you make sculptures for a living. I would expect you to be on the liberal side of the spectrum when it comes to politics. Matter of fact, I don't know if I'd want to buy art from somebody who was super conservative. Right? It just seems strange. Yeah, right. We both had a good laugh about it, right? And we continued our professional relationship. I don't know what
conservative art would look like.
I don't know, but I mean, that's
like a block and a round ball.
I mean, I appreciated him for who he was and the art he produced and that sort of thing. We didn't make a big deal about some of those differences. Anyway, I don't think we'll quite have time for our break here. But so this was, there are cities, check this out, cities that will pay you to move there.
Oh, yes.
There's 3 cities that were listed in this article from the Enquirer, not National Enquirer, so different one. Baltimore, Topeka, and Tulsa are all among places that are paying bounties of up to $15,000 to lure remote workers to their town. And these are places that, places like Baltimore are declining in population. And they're thinking, how do we get people to stay here? So they are literally offering people incentives. It reminds me, you read these stories every once in a while about you can get a huge house in Italy for like $1. You've seen these stories.
Yes.
Right? A massive old, what do you call like a big estate thing or something? Villa. An Italian villa for $1. They say what you have to make sure you refurbish the thing and keep it.
Before you do that, read the book Under the Tuscan Sun. So before you move to Italy and buy a villa, just a little.
Actually, you probably, I have no desire to move to Italy and buy a villa. And some of these places you can buy a house. Topeka, Kansas, another one of those areas that not many people are. You can buy a house there for $47,000,
and they'll pay up to $15,000. And they're looking for remote workers. And this is going to stick with some.
Well, if you can have a Silicon Valley wage and live in a Rust Belt, but live somewhere where population has declined, where homes are supply demand, right? So there's almost no demand for these homes. You could buy a house for next to nothing. Think what you can do with those extra dollars.
Yeah, in Topeka, you pay $125,000 for a house, right? And it's a tenth of the median price of a house in Silicon Valley.
Yeah, but they're giving some sort of subsidies to get even remote workers here. So kind of interesting. We're going to take a break, and when we come back, we will take some more of your calls. If you want to be part of Allworth Money Matters, our contact number is 833-99-WORTH. Again, 833-99-WORTH. And real quick before we hit the break here, there's a pretty good article on our website, 4 tips for conquering your transition into retirement. So if you're close to retirement, you might want to check that out at allworthfinancial.com. 4 tips for conquering your retirement into transition. Your transition into retirement. This is Allworth Money Matters. We'll be right back.
Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast.
Welcome back to Allworth's Money Matters. Scott Hansen.
Pat McLean. Thanks for sticking with us.
Let's head back to our callers here. And if you'd like to be one of our callers, have a question for us, call us and we will schedule time. Or you can send us something at questions@moneymatters.com. Questions@moneymatters.com, and we'll help you out there as well. What I mean by that is we will, if you'd like to be on the air, we will schedule it. It does not mean we're going to answer every question you send to us.
Yes.
Questions@moneymatters.com.
No, right.
I've got that before. Aren't you going to answer my question? Like, yeah, I actually have other things in my life to do, but if you want to participate in producing,
if you want to be part of this
this
show
program, yeah.
Or I guess if you had a question, I don't know, send it in and we'll see if we answer it.
See if we answer it. All right.
But if you're clients, but I should state, if you're a client or want to become a client, you're interested in that. But if you, send in a question.
I reached out to it wasn't an accountant, or it was something like an accountant or attorney. I don't want to say it. I sent an email. I was a client. I sent an email. 48 hours go by. I hear nothing. I sent a follow-up email. Did you get my email? Oh, yeah. Let me have my assistant reach out to schedule a time for you to call. Another 24 hours go by before I hear from the assistant.
And he was a client. You were a client.
I was a client. And I thought, I could ask that, you said, if you're a client, all calls are returned within 4 hours. Emails are returned before the end of the day.
But if you want to consider becoming a client, reach out to us. Or if you just have a question, we'll get you on the air.
Correct.
But the nature of what we do, it's really difficult to answer financial questions over email. It is.
Well, because there's usually more questions. And oftentimes we answer a different question than what the person originally called about.
Very difficult.
Anyway, let's talk to Christina. Christina, you're with Allworth's Money Matters.
Hello. Hey, guys.
Hi, Christina.
All right. So I have a question. I've been contributing 15% to my 401k ever since I started work after college. I'm 28 years old. I currently max out my Roth, but I have minimal funds for a down payment for a house, and I'm really trying to save for a house. So I have 2 questions. First one being, wanted to get your perspective on lowering my 15% contribution just for the next 2-3 years to really build up that down payment. Mm-hmm. And then currently my house funds that I do have is in a brokerage account with Vanguard. It's in a total index fund, and aiming to buy a house maybe in 3 to 5 years, probably closer to 5 years, wondering if it's too risky to be in the stock market since it is short-term investing.
How much, Christina, how much money do you make a year?
A year. I make $94.
And how much money do you have in your 401k?
Aren't you like a millennial?
I know. What's wrong with you?
You guys get a bad reputation. You're got a career, you're doing well, you're a phenomenal saver.
Shouldn't you be smoking pot and riding a surfboard?
Smoking pot. I think I used that phrase with my daughter. She laughed at me. They don't call it smoking. It's weed now.
Oh, is that, you don't call pot anymore?
Apparently not. My daughter said I called it the wrong thing. It's weed.
Yeah.
Weed,
Kush.
Yeah.
Shouldn't you be smoking the Kush?
I don't think
the Kush. Oh, God.
Okay. We're going to date ourselves.
How about the Mary Jane?
Okay,
I like that
poor
one. Let's go
Christina.
with that one.
Christina's super responsible saving, and we turn it. She's a millennial. She must be stoned or something.
Oh, okay. So, how much money do you have in your 401k?
$126K.
And how much money do you have in your Roth?
22.
And how much
my
money do you have in
gosh,
the
you're
total
doing
index fund?
The 16K.
All right. And so, listen, I got a 26-year-old son. He's a good-looking guy.
I don't date younger.
Okay. Well, that was where I was going with this. So now we'll get down
She's
to
already pretty mature for 29, so I'm sure she's looking up.
All right. Well, I would just need to make sure.
Where do you live now? What's your housing situation?
I live in an apartment in San Diego.
Okay, and what's your rent?
So I'm renting. My rent is $1,450 or $1,475.
And you share your apartment with somebody else?
No, I live by myself.
Okay, so you have probably a relatively small apartment, I guess?
Yeah.
And what would a place, if you were to buy a place, what would that cost you?
Oh gosh, I was looking at a place, a 2-bedroom in a nice area. It was like $600K.
And what would the mortgage payment and taxes be? Did you calculate all that out at that time?
Yeah, I did like a mortgage rate calculator, and I believe it was like $1,800. No, that's too low.
Well,
I can't.
Money's
recall off the
cheap
top of
right
my
now.
head.
So money is really cheap.
Yeah, but with
I
taxes
just
and
remember-
insurance, you're probably closer to $2,500 a month with.
And will you stay in that area long term?
TBD. My family's up in Northern California. So TBD if I would buy in San Diego or up in Northern California.
And where in Northern California? Silicon Valley or Sacramento? Or somewhere in between?
My dad is like East Bay.
Okay.
Yeah.
Yeah,
So
and
probably somewhere expensive.
your
anyway.
company has a match up to 6% in the 401k.
So they match the first 25%. They match 25% of the first 6%, but then
Okay.
we also have a separate wealth builder that they do 4% directly.
Yep.
When do you want to buy a house? Do you want to wait 3 to 5 years?
Yeah, I just feel like I'm not really like as much as I would like a house right now. I'm not there yet. So realistically, it'd probably be more closer to 3 to 5 years.
Is there someone in the family that would lend you money for a down payment?
No, I ask my dad all the time. And he denies me.
That's because he sees how well you're doing on your own.
Yeah, he's
like you don't need to be
He's
financial.
thinking, look, if she buys a house, she's supposed to support me in retirement. I would be comfortable lowering your 401k and Roth contributions. And
but
I'd take that total index to cash. Why wouldn't you, Scott?
well, because the Roth, you can take that Roth, you can take your contributions to your Roth and use those dollars for the down payment without any taxes and penalties.
And what's the limit on that? I think it's 10,000.
No, you can always take out your Roth contributions. It's just the earnings.
It's the earnings.
So maybe you put in $15,000 or something. You could pull that all the way out.
Yep.
Would you advise against that, though? I always hear you're not.
No.
Well, you're talking about the same thing. You're talking about either not contributing.
But it does the same thing. Yeah. So if you moved down your 401k contribution to the match and put the maximum into the Roth IRA, we're going to get to the same place.
Yeah.
Yeah.
And then,
oh, wow. You would, yeah.
Right?
Well, I'm just thinking of ideas. I'm talking about.
And then I would take that total index to cash.
I would.
And then I would save as much money. And
what you don't want to do is a time in the future where suddenly home prices are on sale again. They will be on sale again, just like they have over the time, right? There'll be some sort of market cycle and home prices. You don't want to be at a time when home prices are down and stock values are down, and suddenly you don't have the down payment that you're hoping for.
Yeah. Yeah, fair.
So bring your 401k down to the match and leave it at that.
6%.
Yeah.
Okay. I was thinking 10%.
All right, good enough.
You
can swing it.
I mean, you could buy a house today with no money down.
You could.
It's not stopping you.
Yeah.
The down payment, you're just going to pay PMI. But even on first-time home buyers,
There's all kinds of
different programs
first-time
out
home
there.
buyers.
Have you started shopping yet?
She did. She looked at a place.
I looked at one place and then it didn't seem financially possible, so I stopped. I'm just trying to I'm getting a puppy on Monday, and I'm trying to give my dog a backyard.
What kind of dog are you getting?
It's a shepherd mix.
I was super impressed by you until then.
I have a puppy at home right now, so I know it.
Why don't you call a mortgage broker and give them a rundown and see if you can swing it now? Because you might be able to get to the same place by just changing the contributions.
Why are you saving so much?
Why?
Yeah.
Well, my dad just always told me to do 15% in the 401k, and then honestly, the pandemic, I got bored, so I just started investing all my money.
Okay.
And wasn't spending it elsewhere.
And I'm not saying it's wrong. I'm trying to understand the motivations. So if your goal is to accumulate as much wealth as possible, always stay in a small apartment and invest everything else. And if you're thinking about buying real estate, buy a rental.
And don't buy a dog.
Yeah, don't get a dog. But we all make choices in life, right? There are trade-offs, and most of us say, I'm willing to exchange having these dollars in savings and investments and enjoying a meal out with some friends, or enjoying a trip somewhere, or whatever, right? We spend our money on certain things, experiences, and material stuff. We spend our money. So, I mean, if having a place now is of great value to you, I think you could swing it on the income you've got.
I think so. So I wouldn't start with a home. I'd start with a mortgage broker, and then I'd ask them what programs are there for either zero down or limited down, and then and this was the idea that your job is relatively secure, and then I would look to see if you could swing it at that and how much more it is than your rent payment. Maybe you have to lower the contributions to your 401k for a little while. Maybe you don't. And that's why you want to start with a mortgage broker. Don't start by looking at the homes. Start by figuring out the financing before you look at the houses.
Okay, that makes sense.
All righty?
Cool.
Yeah. All right. And remember, if you ever decide to date younger, my 26-year-old, nice. Although I might be biased.
Although she might have this part of her life down perfectly, we don't know the rest of her. So.
Oh, it's probably a
nice
good luck
talking
to you, with you.
Yeah, nice talking.
Right, thanks, guys.
It is always encouraging when people are
You should be proud of herself.
doing so well financially.
Yeah.
And I think the challenge is, Pat, we see people at retirement age that have nothing saved. And people, I have people, my friends, they're my age, that don't really have anything saved. And I think, how is it we both graduated in high school in the early 80s, around the same period of time, and you don't have anything saved?
It's just a view of the world. It's a view of the world.
The view being?
Some people understand how actually money works better than others. And the importance of...
I think you're right on that. And I think some people view it as they take personal responsibility for their future.
Yes.
Like, it's my life, I'd better plan ahead. There will probably be a day when I can't work, even if I don't want to retire.
Yeah.
All right, let's continue on with calls here. 833-99-WORTH. We'll get you on to Allworth's Money Matters. We're talking with Kurt. Hi, Kurt. You're with Scott Hansen and Pat McLean.
Hi, Pat and Scott. This is Kurt, and I have a question. I'm trying to decide what to do with my 401k. I'm 58 and recently retired, and I'm trying to decide if I should pull it from the company's 401k plan and put it in an individual IRA, or perhaps and manage it myself, or have a fee-based advisor manage it for me.
Are you married?
I'm married. My wife is 57, and she plans to work for another 2 to 3 years.
What's your wife think you should do?
She thinks I should give it to a fee-based advisor.
Okay. I was an unfair question because oftentimes.
So, are you living on a pension now?
I have neither of us will have a pension, although we do have a fair amount of savings. And then I guess I do have some income from a trust. that will go on until for the rest of my life.
Okay.
First of all, I got to say we're biased in two ways. One way that we are fee-based advisors. The second way we're biased is my career I've spent with people that have not been great at doing things themselves. That's how they end up here sometimes, right? I have not had a lot of personal experience other than over the radio with people that have done really well on their own.
I have.
How do you?
I have with clients. And it normally it takes a health scare for the person in the family that's managing the money, primarily the husband, that causes them to seek out advice, right? So I haven't seen it from a lot of 51-year-olds that will do it because it's always going to get better. But I've most certainly seen it with people in their early 60s.
How is your 401k balance invested today?
Right now, it's 50% domestic stock, 10% international, and 40% bonds.
And what was it 2 years ago?
It was probably a little more aggressive. I backed it off starting about 2 years ago when I knew retirement wasn't that far off.
And do you own a home?
Own a home. It's paid for. No mortgage.
Okay. So, we are biased, Scott. I mean, there is. I don't know how to. But the reality is,
because you don't see many times you think someone they could do just as fine without you. Because you always think you could help them.
That's correct. But then again, Scott, half the advisors in our marketplace I would not give any money to. But the other half, I'd let them manage money for me. I mean, there's great people in our industry. I guess it's like that in any industry, and there's terrible people in the industry. So. Here's the benefit of actually leaving the money in the 401k. Are you taking income from it now?
I am not, and really don't plan to until I'm 70 or when I have to.
Yeah, then you'd roll it into an IRA. And the reason you'd roll it into an IRA is it just gives you a lot more options.
Have you considered doing some Roth conversions between now and the time age 70 or 72 comes?
We have right now. We're in a very high tax bracket. So after my wife retires, it probably would be the right thing to do. Currently, I do contribute to a Roth every year. The only IRA I have is an inherited IRA. So I continue to put money into a Roth. And I believe if I convert my 401k to an IRA, I can no longer contribute to the Roth.
No, is that correct? No, you can continue as long as you've got wage income, and you can do a spousal contribution as long as your spouse is working and the incomes don't exceed something like $180,000 or just cut off somewhere.
Well, let me ask you a question. Do you have an IRA outside that inherited IRA anywhere in the Roth IRA? Is there any money there outside of that?
No, I do.
Okay.
No, I do not.
So
there's money elsewhere, but not in an IRA.
So this answers the question as why you need an advisor. You answered the question. If you were sitting in our office, we would have made a non-qualified contribution into an IRA and converted it into a Roth the very next day. Are you doing that?
I am, and I have been for the last 10
All
or 15
right.
years.
Well, you could probably
definitely get it out of the 401k. We don't say that to everybody, but I think it sounds to me like you're doing all the right kind of planning.
Yeah, get it out of the 401k. A good advisor is going to fine-tune the portfolio and probably monitor it much closer than you are. I'm assuming you don't run your portfolio through a screen once a week to make sure that it's within tolerance.
No, I do not.
Part
of the 401k is in a after-tax in-plan Roth conversion. Mm-hmm. What happens to that if I roll it over?
Goes to the Roth.
Okay.
Yeah. So the question of whether you need an advisor, why don't you sit down with one and then make the decision?
Yeah, that's probably a good idea.
That's a good idea.
That's a good idea.
Sit down with a couple of them,
and it's going to be a decision, probably a family decision, and then you got to ask yourself, when the next downturn comes, and there's no one to blame, is that going to be a challenge in the marriage? Right? I mean. One of the things I've said for years, I tell our advisors, look, when the markets are going up, our clients take all the credit. When things are going down, we get all the blame. That's just how it is. Live with it, right? Like that's part of the role that we play. And so, I mean, that is some. In all seriousness, it's something to consider. Like when that account's down 20%,
Well, assuming that your wife is not involved in this, at some point in time, you will hire an advisor if you think that she's going to outlive you.
Which odds are?
Which odds are. And that oftentimes for people that have done it themselves their whole entire life. I still remember a gentleman came to me. He was diagnosed with prostate cancer. And I was going through his portfolio and I said, we should do this, this, and this. And he said to me, why didn't I know that? I'm like, I have no idea why you didn't know that. So sit down with a couple advisors and see if it makes sense for you.
Yeah, we wish you well, Kurt. Sounds like...
Excellent. Thank you.
Yeah, thank you. Glad you called. Sounds
Actually got it pretty much together.
We think so.
Yeah, I guess.
You poked around a couple areas and didn't find any holes.
Yeah.
And sometimes financial plan is just fine-tuning. But that fine-tuning can add up.
Oftentimes will more than pay for the cost of the
studies have
advice.
shown. Yeah. Let's talk now with Doug. Doug, you're with Allworth's Money Matters.
Hello, gentlemen. All these, I watch the financial shows and all these debates about minimum wage going up to $15. But you never hear about how it affects retirees, and it seems like it just puts another crip on it makes it a vicious cycle in society, and I just kind of, you never hear about them talk about the older people, and I'm sure that when the scale is tilted, that you're going to see them try to bail out the older people.
So is there a question? It most certainly could be inflationary at a bare minimum. It could be inflationary. It could most certainly affect our imports and exports.
I don't see that having as big an impact on retirees. What has a tremendous impact on retirees is our current monetary policy with interest rates at zero.
And the reason being is that the retiree that has a lot of their dollars in super safe assets, including bonds and savings.
CDs. I mean, retirees used to be able to live on CDs.
They will bear the brunt of this. They will bear the brunt of this. What's that?
I see my in-laws, they're in a retirement home and their rent has gone up. And me, myself, I haven't dined out in a while because of the COVID thing, but, I don't like to spend, more than $50 when I go out to eat, and who knows what that's going to look like. I know that California right now is 14 minimum wage.
Well, clearly it's going to be a cost increase. For some parts of the country, it's going to be dramatic.
Significant.
And the company's going to pass along. I mean, I'm a business owner, right? If it got to the point where there are no profits, like why would I take all this risk? And like you own a restaurant and suddenly you can't, you're either going to increase the price or you're going to shut the doors. One of the two. What else? I've always thought the minimum wage is a curious way to ensure that lower wage people can have the government's essentially dictating that a private enterprise pay an employee a certain amount. Another way to do it is to simply tax and redistribute that as some sort of a minimum income and let the marketplace decide what a wage is worth.
Or do both.
We're already doing both, I think, aren't we?
Yeah.
Anyway.
So, no, it will have an effect on certain industries, but how it affects the retirees, it remains to be seen.
Let's talk now with John. John, you're with Allworth's Money Matters.
Yes, here I am.
All right.
Well, my question was a simple one, and Pat probably knows I'm
John.
a worrier.
John, how are you? It's good to hear you.
And so I'm not looking for advice. I'm looking for you looking in your crystal ball, and when will the bubble burst?
Oh, my.
Which bubble?
Well, the market keeps going up and up and up. And it's been doing it during Obama. It's been doing it over Trump. It's still kind of doing it. It cannot go on forever. So,
historically, we've had a 20% decline every 3 years. if I think back to the last 2 decades, we had 2 periods where we had roughly 50% declines: the dot-com bubble and the financial crisis. But I also like to look at it from my personal perspective. In 1990, when I entered this business, the Dow Jones Industrial average was roughly 2,600. Okay,
Right.
today it's over 10 times that. That's over the last 30 years. That's through 2 absolutely disastrous market periods. So instead of trying to figure out when this current run up is going to end and we're having another pullback in the stock market, I like to think instead of, let's just make sure anything that we have in stocks, we've got a nice long-term time horizon to ride out whatever storms are going to come.
And then the bond portion of the portfolio is what will provide the income through the down parts of the market. And a good portfolio, and for the rest of the listeners, I did not know John was going to be calling, but John has been a client for 20 some odd years, John, right?
Yes, at least.
So,
And I rode through three crashes or 3.
And he doesn't want to do another one, doggone it.
So, but what happens is because the way the portfolios are rebalanced is the equities grow, we're selling off equities in order to keep the portfolio at 50-50. And as the portfolios fell, we were selling off bonds to buy more equities or more stocks to keep this balance. But the reality is that 50% of the portfolio in cash, you have more than enough time to actually live through any recovery.
Yeah. So. And unfortunately, John, we are out of time on this program, and do appreciate your call. And gosh, I wish that we could predict market highs, and you can flip on the television right now if you'd like, find a financial program. You're going to have a bunch of talking heads. They're all going to have a different opinion, and none of them are going to be the same. And I guess maybe you can try to find one you like the most. That would be one strategy. Probably not the best strategy. Probably best to stick with a nice diversified approach.
Patience and persistence.
Yeah. Anyway, we're out of time. It's been great being with you. This has been Allworth Money Matters with Scott Hansen and Pat McClain.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.